What is the current AUM in CCP?
CCP would be about 5,500 crores, 6,000 crores maybe.
Sure. And see, the one common question that I have been kind of facing from almost all investors who had earlier invested in Marcellus, because CCP was the first strategy, that it is like, we understand that market dynamics changed, markets used to be narrow, and CCP took time to understand the dynamics are changing and markets today are broader. You're bringing these changes in the portfolio, but you have been launching many other portfolios, and underperformance is not only in CCP, underperformance is across almost all the PMSs. So it is maybe not only to do with changing market dynamics, it could also to do with some overall I think issue behind the way, in terms of the overall I would say architecture, the way you identify businesses as a firm. So I because obviously you are a popular fund house, and there are a lot of large clients who have given you hard-earned money across not only CCP but KCP, LCP, and others, rising giants and all. I would want to understand, you are a founder of a company, and then there have been a lot of hopes. So what is your personal understanding? Because I know your own personal money is also invested in some of these strategies, right? So skin in the game is there. So it would hurt you also equally.
Yes.
Hence this question.
No, great question. So look, I mean, we started this venture having invested our life savings in it, and at the outset, we set out one clear principle here, that we would want to make money if we can help our clients make money only, right? So we were one of the first to launch a zero fixed fee option. We decided all the founders and investment team members have to invest 100% of their equity investments in Marcellus' portfolios. We are not allowed to invest in any stocks outside or any other mutual fund or any other PMS. And all of us are shareholders or option holders in the case of some of the junior members. So we've tried to demonstrate skin in the game in many ways, right? So therefore, the intent is clear, that we want to make money only if we can help our clients make money. And we did, right? So like I said, not just CCP. CCP compounded at 27%, 10% alpha for the first 3 years. Our small cap portfolio, LCP, compounded at 31% for the first 3 years compared to the benchmark 19%, a 12% alpha there. So it's not like over this 5-year period, we haven't made any money at all. But having said that, we have to be introspective, look inwards and see what mistakes we've done. Like I said, we have to be honest in terms of acknowledging the fact that the broad basing of the economy hit us in two ways. One is we missed out on some of those sectors in the early recovery stages, but that broad basing also meant that the stocks that we held had to go through a derating. At the end of the day, the valuation is a relative game, right? HDFC Bank or Kotak got 4 times price to book valuation in the last decade simply because there was hardly any other bank to invest in. Right? Forget about the PSU banks, even a couple of private sector banks like ICICI and Axis also were going through that problem. It is that scarcity premium that was built into it. And when the market becomes broad-based, the scarcity premium tends to get diluted. Now, we could have, like I said, there were several false starts in those last 10 years itself. Post the taper tantrums of 2013, when the pre-election rally began, a lot of people said, quality is done and dusted. It's going to be value and broader stocks. That turned out to be a false start. Eventually, we had the correction in 2015. And again, post demonetization, we had a massive rally in 2017. Again, people said quality is pretty much done. We have to look elsewhere. Again, we saw that 2018 where quality, people got reminded of the benefits of staying invested in quality. Now, one could argue in 2020 when, to be honest, we did a lot of work on a number of capital goods and industrial sectors as early as late 2020, early 2021. One of the parameters in our stock picking criteria for many of you who know, the first step is forensic accounting to weed out all the dodgy corporate governance companies. The second is to look for companies which have had a return on capital greater than cost of capital consistently over a long period of time. And the third is to look for companies which have also had a revenue growth greater than nominal GDP growth, right? We want to invest in businesses, not just because they make a lot of money, but they also can reinvest for future growth. So in a number of sectors where the sector did not have a favorable macroeconomic environment in that last decade, there was no consistency of growth for as long as 10 years. Typically, we use 10 years because typical cycles last for about 6-7 years. So if you use a 10-year look back, you're not particularly focusing on one period or one part of the cycle. You're looking on it on a cross-cycle basis. Unfortunately for us, those 10 years, India went through a very, very unique cycle. It was not even a cycle. It was just a one-way journey where the investment cycle in the country was frozen. So therefore, even if you were the best industrials and capital goods company, you couldn't have demonstrated that consistency in growth. That created a barrier for us to take positions in those companies. Now you reflect it. Luckily, we are turning the corner as a country. It is good. No country, no economy can sustain purely based on consumption or IT exports or pharma exports. We need a manufacturing cycle. We need an industrial cycle that was completely absent. Today, we are seeing the beginnings of that, triggered by the government spending on public infrastructure. The government did much of the heavy lifting on it, and hopefully there is trickle-down effect. And we've also had the benefit of the cleaning up of the banking system. Today, the banking system is at its all-time high in terms of capital adequacy ratios, which means that the banking system is ready to provide credit to businesses which can borrow and reinvest in capacity. Similarly, corporates have deleveraged, right? So therefore, they are in a much better position to invest into new capacity expansion and grow. And I reckon we're just at the beginning of this industrial cycle. Right? It's not like we're too late. By the way, why we're doing this webinar today, but we've begun the recognition in the changing process almost 18 months ago. We couldn't have overnight woke up and said, okay, we'll buy these 6 companies, right? It takes a lot of time to figure out which companies suit our criteria, at the same time provide us exposure to the new legs of the economy. It takes a lot of time, given, our style, we tend to sort of get to the brass tacks of the business from a bottom-up research perspective to give ourselves the comfort. And like you said, we are investing people's hard-earned money. We can't do it on a whim. We have to do justice to it. People are paying us to do that hard work in terms of research and diligence before they make it into the company. So it's almost an 18-month long work which is taken. It's not just in CCP. You're seeing the changes in LCP and Rising Giants as well. All these portfolios have become much more broad-based in terms of sector exposure, number of companies and all that. So we have made our mistakes. We've learned our lessons. We've taken corrective action. Now we're in front of you presenting what those changes are and what to expect going forward.
Sure, Pramod. So, I remember having done webinar with Rakshit last year in March, where I was telling him that, rather than thinking of historical compounders, one should be looking at maybe future compounders, but maybe never the less now you are making those changes, which is like, good and welcome. And I know, you had added trend as one stock, which I know many other portfolios also had, that kind of, had some kind of added return to your portfolio. But now you have made few more changes, but I only wish that if these changes were done a little faster, because obviously the dynamics of the economy had changed long back. And I know many fund managers, I don't want to name them, which came up with strategies which were focused on broader markets, which were trying to, kind of demonstrate the shift towards manufacturing industrials, right? And many sectors had, and in fact, in earlier times, reduced financials, but you had launched KCP, so from that point of view, it's like now, it is a good thing that you guys are realizing and changing, but I am kind of wanting to tell you that this is an ongoing process in my view.
Yes.
So obviously you have to follow this as an ongoing process. Correct. Because these things may change because markets are cyclical. Stock markets, in Indian context, because India itself is discovering and kind of, evolving. If we will evolve from 4 trillion to 5 trillion, obviously, many new industries will set up. We cannot be just historical in our approach. So that's what clients have been telling me to give this feedback, because many of the
point
clients
taken.
who have invested in your strategy are themselves very successful in their businesses, in their jobs, in their professions. So they are smart guys, right? And they deal with many other fund managers. They read your books, they read many other books, and they also watch many of the webinar videos. So their feedbacks have to be kind of I would say acknowledged. So it is good to kind of hence
Absolutely.
understand that yes, you guys are bringing all these changes. One another feedback which I have been getting from many clients is that you have been launching strategy after strategy, but it's like it reflects that you are not taking the responsibility of the older clients and acquiring new clients. So this is something which I do not know why this has been happening, because I know from your point of view you are trying to cover all your ideas through various portfolios, but from the point of view of existing client who has given you money, it feels that I am not being taken care, a new client is being acquired, right? So that is what kind of again something which investors have not liked. So I would want to maybe understand from you, what have you guys been kind of thinking when now when I'm sure you must be getting this feedback yourself also from your clients. So what are your thoughts and guidance in this regards? Because more than the changes in the strategy of CCP, clients want to understand that the learnings and the changes in your thought process, in your philosophy as an organization, because that is what I think investors are more keen to understand. And I am trying to be very unbiased here. It's like because that's what ultimately is the value add that we as a platform PMS AIF World have been offering and throughout.
Correct. No, fair question. Absolutely. So look, there is absolutely no doubt in our mind that the only reason we exist is to deliver returns to our clients. Risk-adjusted returns better than the market. We recognize that our clients have an option of investing in other PMSs, other mutual funds, or worst case index funds. So at the very least, we need to deliver alpha on a post-fee basis. There is absolutely no doubt in our mind. And we're also clear that if we want to grow, we have to deliver returns, right? It's not like investors are oblivious to that performance. So performance or growth will not come at the cost of performance. Performance is the fundamental criteria. AUM growth or asset growth is a function of that. It's a result of that. It's not unrelated to it. So we know that, look, no matter how many new products you launch, if we don't deliver to the clients, we're not going to get assets. That's not the point. The reason we launched that is, remember, while today a lot of small cap funds are running in tens of thousands of crores, we closed our Little Champs portfolio at 300 crores when we had demand for another 500 crores, right? So that should be a demonstration of the fact that we can look at assets in the eye and not blink at it, because we were clear the sort of segment that we were looking at was extremely illiquid, and we did not take a single rupee after that 300 crores. Now, a couple of years of strong performance of Little Champs, a lot of clients told us, okay, fair enough, don't do the sub BSE 500. Can you not build a mid-cap portfolio? That gave rise to Rising Giants, right? We were pretty much happy with CCP and LCP and KCP. That gave rise to Rising Giants. In hindsight, I'll tell you that was perhaps not the right time to start Rising Giants. In fact, we've gone on record in our webinar, including my colleague Saurabh, who's acknowledged that we shouldn't have started Rising Giants at the peak of a quality cycle in 2021. Like I said, that look, we all make mistakes and totally recognize the disappointment with investors, but key is to recognize that, acknowledge that, and take corrective action and move on. And we have taken corrective action. So as far as the organizational philosophy is, we are clear. We are here to deliver returns. Growth is an effect of that. And mind you, we are privately owned. 90% is owned by us founders and staff. Therefore, we have nobody to answer to. If we don't grow assets for 2-3 years for reasons that we believe is the right thing for our clients, we have no problem. We did that, right? In LCP, we closed it at 300 crores dot, not a single rupee more than that. If we see our style of investing becoming overvalued, say like in 2021 again, quality becoming frothy, we will stop taking money from investors, and we have no doubt about that. So to answer your question on organizational philosophy, we're extremely customer centric. We want to make money if only we can help our clients make money. The rest of it, growth and how big we become, what new products we launch, are just a result of that and not the main criteria.
No, sure, Pramod. This is like, reassuring, and my good wishes to you, for all the future endeavors. One more aspect, the kind of, I would say, changes you talked about that you are making in the CCP's portfolio. So, what is the, I would say, investment committee behind it? As an investor, or as a, I would say, representative of our clients and investors, they also want us to kind of ask you, because earlier the understanding was that you guys have done a lot of research in understanding there is a concept called consistent compounding, and obviously you borrowed that concept, you wrote a book on that, right? And there was a lot of data around it. India's economy was throwing a lot of fundamentals around it, right? And then you kind of created your branding around it, and then you moved on to I would say launching new products which gave you larger AUM over time. But now, maybe after 5 years, I'm sure there is some process, like there are large fund houses who would say we have sector specialists, we have economists, right? And we do, like you say, we check corporate governance and forensic. Obviously all these things, what you're saying is what we believe, but I'm sure there will be some day-to-day check, like you mentioned that it took you 18 months to realize this change, right? So there is definitely it's like 18 months is not a small period. It's like you are boasting that it has taken you 18 months, but from investor's point of view, who's given you money, he feels that why it took you 18 months. Look, investor wants to question you on that, and he has a right to question you. So hence there is this question that what is the process today? What is that process? How many people you have as a sector specialist, or I do not know, maybe you guys are creating some new style of operating. So from that point of view, because these are some of the real answers that investors want to know. We 100% believe in that yes, you are 4 founders who have a very good intent, who brought zero fixed fee option. You are the ones who actually introduced people to PMS. People were, I'm telling you, because Marcellus has been so vocal and has done so brilliant marketing on social media. Many people were not even aware of what is a PMS. They were either investing in mutual funds or maybe investing in stocks directly. So you did a very good work in introducing people to PMS. But at the same time, it is a responsibility that you have taken, in raising hopes of investors to a PMS structure. So it's like, if Marcellus PMS is not performing, people are now kind of thinking that PMS as a product structure is not good, because you are the ones who introduce investors to PMS, right? And we are a platform which is representing PMS AIF as a ecosystem, right? So from that point of view, I want you to kind of express what is the process of research that you as a PMS house follows, and why it took you 18 months, and how does a day look like in your company when you kind of come, and because there are many clients who say that you guys are only doing sales, you're only coming on TV, you're not changing stocks, you call yourself as fund managers, right? So these are like very, don't take me wrong, right? So these are like practical questions, people who have like missed the bus, because rallies do not happen every year, and there has been 2 years of rally that we have seen, right? People have missed that, so people feel bad, hence these questions.
No, fair enough. So like I said, we have taken people's hard-earned money. People have every right to ask these questions. We owe it to them. The least we can do is answer those questions with an honest intent, and we've never shied away from that, right? Even during this period, we have done our own webinars. Now, in terms of the process, right, nothing much is changed in terms of the team structure. We've had one of the larger teams in PMSs. Our research team is more than 20 people. There are sector specialists. Each portfolio has a separate fund manager, and on top of that, there is an investment committee for each of these portfolios as well. It is a team-based effort where the research is done across the board with combination of the CIO, the investment committee, the PM, and the research analyst. And literally every week, the whole team gets together and shares insights about what they have found. Like I said, it was more about broadening the universe, which has been the bigger change, because the filters threw away companies which did not show any growth over the last decade. right? I keep coming back to it. It's not like there is a whole host of problems. In fact, people talk about valuation. Valuation is automatically corrected by the broad basing. I talked about why an HDFC and Kotak were trading at 4 times price to book in the last decade. It was a scarcity premium. There were hardly any other banks which were demonstrating any growth. So reflection in valuation is the fact that if you find that the economy is a lot more broad-based, where there are a lot of other options, there's no more scarcity premium. That needs to be reflected in valuation. So even the valuation angle boils down or ties into the whole broad basing of this. And when I say 18 months, I'm saying we began this process of correction 18 months ago. I'm just talking to you now, but these changes have been happening. For those who are invested, they can always see in their portfolio statements that this is not a change that we've brought in today either. But that process of research is as rigorous as it was ever. The forensic approach is as rigorous as it was ever. We are not compromising on those elements. We will do very, very in-depth bottom-up research. We are not going to change our style to trading in and out of stocks based on tips or broker research. We do use sell-side analysts, but bulk of the research is done in-house. Those aspects of our philosophy is not going to change, right? I'll come back to the bigger change is broadening of the universe that we invest in to include certain sectors which are now part of the growth cycle, which were not part of the growth cycle over the last decade. And that automatically sorts out the valuation issue as well, right? Once you look at the market as a broad-based market, why should I pay 4 times price to book to any bank anymore when there are equally good banks available now, if not as good, but at least one notch below, available at cheaper. You extend that logic across the board, valuation automatically gets sorted out.
Sure. So what is the guidance that you want to give? Because I know you guys have been giving guidance based on the earnings growth of the portfolio. Yes. Because portfolio had consistency in earnings. Now you have made some changes. After the changes made in the portfolio, what are the attributes of the portfolio like in terms of its valuations, earnings growth, and hence what is the guidance that you have kind of set for yourself in terms of your own targets? Based on that, obviously investors can understand that what to expect as a way forward.
No, so we're still looking at a portfolio level earnings growth of almost 20%, right? So if in the long run, if we have bought companies at fair price, I'm not saying a deep discount, at a fair price, eventually the return you're going to get is more or less akin to the earnings growth itself. And now add to it whatever the fees, typically fees are 2%, so that 20% sort of growth in the portfolio might result in 18% post fee returns, and that is something that we continue to target, and we're pretty confident of delivering, on a cross cycle basis. And like I said, the Nifty is given about 14% in the long run. If we end up delivering 18% post fees, we would have outperformed the Nifty by a reasonable 300-400 basis points.
Sure. And, we know, as you mentioned, that markets, as per now your assessment, have become broader, right? So, election is kind of a no event. India is headed towards, continued path, which is like filled with reforms. And hence, this broad-based markets will continue. But at the same time, there are geopolitical risks, which are always there, and market is always uncertain. Equities are always uncertain. And CCP has actually done well during uncertain times. And that is where I started, like 18, 19, 20 was relatively uncertain time. And after that, markets have actually done, a very good growth focus because markets became kind of broader. So now when you have made changes at this juncture, have you also evaluated that if now again the cycle changes, because though, election is no event, I'm not talking about election as a risk, but uncertainty could come from anywhere, and investors who have given you money, they have kind of maybe held money with you, keeping in mind that at least your portfolio has low beta, has higher consistency, has more quality. And if you're changing character, and it may hurt again if market environment again turns difficult, and risk could come from anywhere because future is uncertain. So how will you balance investors' expectations as well as the return and alpha which you are now trying to chase?
So great question. No, obviously, I would also be concerned if I came in because this is a certain type of portfolio and suddenly these guys are changing, which is why I want to reiterate, there's absolutely no change in the philosophy. Right? We are married to quality as a factor. Those three factors that I talked about in terms of very strong corporate governance, businesses generating return on capital greater than cost of capital, and sustainable competitive advantages are non-negotiable for us, right? These are the key tenets of the philosophy. The only change, I reiterate, we're making is broadening the universe, which includes certain sectors which were hitherto not part of our universe simply because they didn't demonstrate consistency in growth over the last decade, right? That's the primary change. And in fact, right, if you see uncertainty, we continue to be confident that CCP will come back with a bang in terms of relative outperformance, because the underlying characteristics of strong balance sheet, obviously a great strength during adverse periods, during uncertain periods, cash-rich companies will obviously be at a much better advantage to take market share from the not-so-weak companies. So a strong balance sheet, which is a result of that high ROC, will come in handy. And as we have seen in the past, any sort of uncertainty, there will be a flight to safety, and often that means flight to quality, and quality will outperform. If your base case assumption is that there is uncertainty in the global economy or the market economy, we'll be even more confident that we will regain the underperformance much more quicker. But I'm not basing my investment decision based on a certain macroeconomic scenario, based on certain events. All I'm saying is that the last decade was an exceptional period for the Indian economy where it was not a typical economic cycle. And again, to reiterate, the changes that we've brought in, this is not the end of it, right? It is a continuous process. The fact that we are saying that we need to reflect the portfolio whilst adhering to the whole quality principles, but reflect the portfolio to the changing environment will mean that we will be a lot more nimble. Remember, I mentioned you will see a slightly higher churn, slight as ever, but that means that we will be more proactive in terms of taking corrective action, whether it's because of overvaluation, whether it's because of growth slowing down, whether it's because of some macro headwinds or regulatory headwinds. So that agility will be a significant change from the past as well. But to reiterate, there is absolutely no compromise on quality as the core tenet of our portfolio.
Sure. This is like, quite, again, encouraging and reassuring. Last 5 minutes, maybe, if you want to spend on some of the stocks that you have kind of exited, you mentioned that, but, if you could maybe reiterate, these are the stocks that you have exited and why you have exited, and these are stocks that you've added and why you have added. And you can cover maybe, once your top stock used to be, for example, Industries. Dr. Lal Path Labs has been kind of, struggling for some time. So these were like heavyweight stocks in the portfolio. HDFC Bank, all of us understand, but what is your stance on that, on HDFC Bank also? If you may want to cover these 3-4 stocks, that will give some more guidance to the clients.
So you were saying Page Industries, Dr. Lal, HDFC Bank, and?
Page Industries, Dr. Lal, HDFC Bank, and Divi's Labs.
Divi's Lab, right. Okay. So Page, like I mentioned, remains a high quality franchise, but it's growth has slowed down here. Also because the reinvestment rate in the business has come off. And like I said, ultimately it's a relative game. We don't have to own everything that's high quality. Within the high quality basket, if there are companies which we find are better growth prospects available at reasonable valuations, we will switch that. In Page's case, we've reduced the exposure simply because we find that the growth is coming off quite sharply. In HDFC Bank, we've actually not cut exposure. We believe that whilst the delay in deposit growth, which in some ways is not company specific, right? Broader deposit growth in the system has been challenging, partly because of the tight liquidity situation that the central bank is maintaining. Rightly so, inflation was a threat even until recently, but that's cyclical. As the monetary conditions ease out, we reckon the efforts that HDFC Bank has been putting in will result in that deposit growth. It's only, mind you, even during this tight liquidity condition, HDFC Bank's deposit growth has been one of the faster growth in the banking system. So they continue to take market share on the deposit side. It's just that more than any other bank, they needed those deposits to replace the borrowings of HDFC Limited, the parent home finance company, which the reverse merged into it, effectively to replace the high cost liabilities of HDFC Limited with their lower cost of CASA. Now, the CASA cannot be grown overnight. CASA typically grows in line with nominal GDP. This is where HDFC Bank's investments in branches will help them. But more importantly, as liquidity situation eases from a monetary policy side, we should see the benefits of that coming through. And again, the market will reward incremental change. If they can demonstrate that they are replacing the high cost liabilities with lower cost liabilities and reflect that in margin expansion, you will see a benefit of that given by the market in terms of re-rating as well. Here we remain very, very confident. The other stock you talked about was Dr. Lal Path Labs. Now, Dr. Lal Path Labs underwent two sort of threats. One was, COVID was a brilliant period for them for obvious reasons, with RT-PCRs left, right, and center. Their earnings went through the roof. Market rewarded by its valuation also going through the roof. And then in 2022, obviously, when COVID ended, that tailwind went away. In fact, on a year-on-year comparison basis, they had to report decline in revenues, which was in some ways expected. I don't think anybody expected COVID to remain forever, and therefore RT-PCR-driven revenues to remain forever either. But what happened was, because they were making so much money, there was a lot of new entry that happened into the diagnostic space, particularly funded by venture capital and all that, who started quite predatory pricing, which in turn put pressure on top line. Mind you, a lot of those new competitors have vacated the space, thanks to the funding winter in the VC space. That aggression that startups showed has mellowed. In fact, VCs themselves are telling their startups to look at unit economics first. First, show profitability, then you can spend to take market share through these predatory pricing. So that's behind us. However, growth rates of the whole diagnostics industry itself has come off. What used to be sort of a 20% growth business is now becoming more like a 15% growth business. Why is that happening? Partly because the pace at which the sort of diagnostic chains were taking market share from the mom and pop standalone labs has reduced. Because remember, during COVID, even the mom and pop standalone labs made a lot of money, right? Even they were getting a lot of business. Historically, the efficiency of a chain like Dr. Lal's or Metropolis meant that they were competing quite strongly with the standalone labs and taking market share from them, either by acquiring them or displacing them. Given the lease of life COVID has given to many of these labs, those labs are not ceding as much ground as they used to. And secondly, a lot of hospital chains have also realized that there is money in diagnostics, and therefore they are pushing their in-house diagnostics quite strongly, which has come up as a fairly strong competitive threat. And that's the reason we've reduced Dr. Lal Path Labs as well. In DVS's case, however, we haven't reduced. We do recognize that they also got a windfall in the form of molnupiravir, a drug that they supplied to Merck was used in treating COVID. So therefore, they also made a lot of money during that period. And as COVID went away, the revenues from that drug had to come off, and that resulted in a decline in top line and bottom line as well. But having said that, from a structural perspective, Divi's today is in a much stronger position from pre-COVID, actually. In fact, the fact that they could synthesize and manufacture molnupiravir in such a short period of time and supply it in such a large scale for its client is only increased its stature amongst other big pharma companies to use them as a contract manufacturing partner. It takes a lot of confidence on behalf of the big pharma, because you are literally giving a molecule and intellectual property. You need to have the confidence that the partner will keep that intellectual property intact, and at the same time be very quick in terms of responding and scaling up the manufacturing, because these are patented drugs. You get a small window to make very high margins, and therefore you need partners who can respond very quickly in terms of scaling up. Divi's has actually ticked a lot of those boxes from those molnupiravir experience. Of course, they've been doing this for the last 25 years, but if at all, I reckon their competitive position has become much stronger. You're already seeing this stock also recover quite sharply over the last 1 year. So here we are not actually reducing the position. So that's the 4 stocks that you talked about. Hope that helps.
Sure, Pramod. I think this has been a very required webinar, and we have done that at the right time. Thank you so much for joining, and thank you so much for answering all those questions, which I had on behalf of all our clients and investors.
Yes, no, thank you. Thanks, Kamal, for being honest. I must say, being direct, you're doing a great job for your clients, representing their interests, and we would love to work with people like you who are straightforward and not just being politically correct. So I thoroughly enjoyed this. I would rather have a more honest and direct discussion like this than any other way.
No, absolutely. It's a question of investors' money, and we all are kind of in the business of promises towards our clients, and time is money. Obviously, hence we have to give value to the time also that clients have come to attend this webinar. We cannot just talk theoretical stuff. And absolutely, thank you so much for your patience and all the replies, and thank you everyone for joining us today. Thank you.
My pleasure. Thank you so much.